Good morning and thank you for joining us on Morning Markets from True Potential. Today we'll continue to build on the discussion that Matt had yesterday about the difficult backdrop for asset markets at the end of last week, a situation that continued yesterday where we saw weaker equity markets and weaker bond markets. The impetus for that really comes back to those things that we've been discussing over recent weeks and indeed months, that of rising energy prices and also interest rate expectations. Really yesterday, the main driver of rising energy prices, primarily natural gas, was confirmation from Russia that they would be closing the Nord Stream 1 pipeline, which brings gas from Russia into Europe and in particular Germany, for 3 days of maintenance next week. That follows on from Nord Stream 2, which was closed for maintenance and has continued to run at subpar in terms of the capacity that it's delivering into Europe. So raising concern on that supply of gas into Europe at a time when Europe is continuing to try and build its gas supplies ahead of winter. In addition, that stoked concerns about the growth outlook for Europe given the curtailment of energy, the implication that that has for electricity prices as well. Not only did we see that in the bond market and in equity markets in terms of the performance there, which you can see on the ticker at the moment on the screen, but you can also see that in terms of currency markets. In July, we commented that the euro had broken through parity with the dollar. It moved back above that level through the latter part of July. Yesterday, with that as the backdrop, we saw the euro weaken back through parity with the dollar, and that was going back to July. That was the first time that had occurred in 20 years. Dollar strength, US dollar strength, continues to be really a feature at this point in time, reflecting a couple of factors. One, the strength of domestic energy supply within the US, but also the interest rate differential that we see, particularly between the US and Europe at this point. So continued expectation that we will see rates increasing in the US in response to these higher inflation levels that we've been discussing. And that's a point that a number of Fed governors have been illustrating over recent days in terms of their speeches. That comes ahead of Jerome Powell speaking on Friday, I believe, at the Jackson Hole Economic Conference, a very much focused upon event and really an expectation that he will talk more aggressively, or in market parlance, more hawkish about the direction and the need to sustain policy at higher levels. I do think it's worth commenting on that we as a team have been commenting on inflation and higher energy prices and how they're feeding through. One area that we've continued to see actually a weakness has been that in the oil price, and we'll all have seen that at the petrol pumps where the price has certainly come down over recent weeks. And really that's a function of a couple of things. One, supply continuing to be relatively robust, but also probably a more reflective view on the outlook for economic activity. So that slowdown in activity feeding into the oil market, and also a little bit of sort of geopolitics as well, with speculation over the weekend that the Iran nuclear deal, which President Trump suspended, might be back on the table, and that would bring probably about 2 to 2.5 million barrels of crude back into the global oil market, something that would really be helpful at this point in time. Just looking to the day ahead, we'll get some indication of purchasing managers' indices in Europe, the UK and the US as we go through today, and we'll certainly comment on those tomorrow. So please do join us again tomorrow. Many thanks. If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.